Hello and welcome to Elevate Your Wealth. I'm Casey Elkins, co-founder and managing partner at Elevated Financial Management. We've got a really exciting show for you here today. We're talking about Social Security. We know there's lots of questions there. We're going to get right into them. But before we do, I'm joined as always by my friend, father-in-law, and business partner, Marc Stimpson. How you doing, Marc?
I'm doing really good, Casey. I'm very excited to be doing the show with you today. And I just want to start by thanking our viewers so very much for watching our show each and every week. And I think this episode you're going to find very enlightening in a lot of different ways. We know that Social Security causes a lot of angst and questions that need to be answered because so many people might end up making a mistake as to when they claim, what do I do as far as a spousal benefit? And we want to answer some of those concerns today on our show.
Yeah, that's exactly right. You know, we get these kind of questions in the office all the time. We're not on TV all the time. We're in the office with clients, right?
Yeah.
So we're having these conversations firsthand. And we see what people are talking about and what they're worried about. And I think we should start with this because it's a really common misconception, or at least there's a lot of questions about it. And that is, how is Social Security taxed, or is it actually taxed?
Yeah, this is something that we're surprised at the answers we get sometimes, right, Case? Sometimes people come in and they literally believe that their Social Security, they pay tax on it and they're not going to pay tax again.
Right.
And we have to give them the bad news in that regard, right? And it's all dependent on all of your other sources of income, right? There's only three brackets, tax brackets, when it comes to Social Security taxation. You're either going to be in a 0% bracket, a 50% bracket, or an 85%. And I will just say this, the bulk of our clients, well over 90%, are always going to be, whether they're single or married filing jointly, they're always going to be in the 85% bracket, right? Because a couple, that's only $44,000 of combined income. So the way taxation of Social Security works is you'll take all your sources, we call that provisional income. Then we're going to take 50% of your Social Security benefit. We're going to add those together, and whatever that number ends up being is going to determine what bracket you're in. And so when I mention, or Casey mentions, the bracket of 50 or 85%, that doesn't mean that you pay 85% taxation, which some people truly believe. We hear that. No, you're going to have to declare 85% of that Social Security total benefit to your taxes and then pay whatever bracket you're in, right? We call that, we want to know what the effective tax bracket is, right, Case?
Yeah, so essentially you pay taxes on that portion of your Social Security, right?
Yep.
And that is a big misconception. There's a lot of misunderstanding there, and it does trip people up, right?
Yep.
And as a matter of fact, we've had folks that have come into the office that have called Social Security to try and get answers about not only the taxes on their Social Security, but also when they should file. Should they take a spousal benefit? How does a survivor benefit work?
Yeah.
And I think those are things that we should discuss today too, because ultimately, again, we get a lot of questions about it and there's a lot of uncertainty. So there's one example that comes to mind specifically of a client that came in that was directed not to take the survivor benefit by Social Security.
Yep.
And what a big miss that was. And she really missed out on a lot of income that she could have had from Social Security from her late husband.
Right.
But she got the wrong information when she called Social Security. Maybe you can expand on that a little bit.
You know, this is where I think working with someone that is a nationally certified Social Security advisor can really help. We are very, very concerned about the information that clients and prospective students that come to our workshops are getting. Because if you call Social Security and you're just talking with somebody that answers the phone, they're really by law not supposed to give out advice. And we are definitely understanding that that is not the case. And the case you just mentioned cost her several years worth of benefit, tens of thousands of dollars that she could have collected, and because she was told something inaccurately, it cost her. And we don't want to see anyone learn from the school of hard knocks. So please, I can't overemphasize, both Casey and I, you need to really be working with someone that understands Social Security. There is a lot of different, we call it levers, that you can pull right at different times and for different reasons. And so you really need to be working with someone that knows what they're doing, because if you don't, it can end up backfiring, right, and cost you a lot of money in the long run.
Yeah, you're right. And that was absolutely the case for her.
Yep.
We've seen that for other clients as well, where they just got misinformation, and undoubtedly from somebody at the Social Security office who was trying to help, but just gave misguided information. And as Mark mentioned, they're not supposed to be answering those type of questions, really, right? That's not their function. And so this is where it comes down to working with the right advisor to help you build a retirement plan and make sure that that's going to be sustainable into the future, and that you don't make that mistake on Social Security, because that's a mistake that's going to haunt you for the rest of your life.
Yeah, in fact, I have another really quick client story where she was working with one of the big box stores. She's a registered nurse in the Seattle area, and the sad reality was that the box store she was working with, she was counting on them to give her good advice when it came to Social Security planning. She trusted them. She ended up being a year past age 70. So she's 71 years old, and we all know that you must start collecting at age 70. There's no benefit to wait. She missed a whole year of benefits because she didn't get the help and thought she was going to continue to build that benefit amount up, right, during that whole time she waited. And what a mistake that was. And I felt so bad for her. But again, she trusted an organization that didn't know what they were doing or had the experience to deal with Social Security. And a lot of those firms, that's the way it is. If you want to talk about taxes or Social Security, they tell you to go talk to your CPA or talk to somebody that knows about Social Security. And that is devastating to get the wrong advice, because it cost her literally thousands and thousands of dollars.
Yeah, you're exactly right. That is a big mistake. It's something that we see those type of scenarios really more frequently than we would like to, obviously, right? And those mistakes, as we mentioned, those can last a lifetime, and it's money that you're never going to be able to go back and get. So for those of you watching from home, this is your opportunity to get a written financial plan where we will talk about optimizing your Social Security, making sure that you're being tax efficient as you take income in retirement. How do you create the income while you're in retirement? What are you going to do for long-term care or Medicare? We haven't even talked about Medicare yet today. So there are a lot of things to consider when you're building out a retirement plan. This is your opportunity to get that written financial plan, completely complimentary, no obligation. You see the number on the screen, 844-342-7142. Don't hesitate, pick up the phone and give us a call. You can also scan the QR code, and that will take you directly to our website where you can set an appointment there. Don't change the channel. When we come back, we're going to play a game called Two Truths and a Lie and figure out what you need to do to make your retirement a success.
Call 844-342-7142 to receive your complimentary written financial plan and Social Security optimization report. Get the most from Social Security payments. Find a strategy that maximizes your Social Security benefit and preserves the assets you've saved for retirement. Social Security seems easy, right? The question is, should you take it now or later? There are numerous ways to take Social Security. The decisions you make can also affect how much you pay in taxes. You've paid into Social Security for decades. Now you want to make sure you optimize your retirement income. Call Mark, Casey, and their team at 844-342-7142 for your complimentary written financial plan and Social Security maximization report. You need a retirement income plan that accounts for all your assets. Call Casey, Mark, and their team right now at 844-342-7142 to receive your complimentary written financial plan and Social Security maximization report. Or use the QR code on the screen to schedule your appointment today.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks today.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the 4th worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. Call now for your own complimentary portfolio review and written financial plan. Hello and welcome back to Elevate Your Wealth. Again, I'm Casey Elkins, co-founder and managing partner at Elevated Financial Management. I'm joined by Marc Stimpson. We just talked about Social Security, some of the pitfalls that clients can fall into. We want to make sure that you don't get tripped up in them as well. And now we're going to play a bit of a game called Two Truths and a Lie. And I think this is really interesting because this really helps to debunk some of those myths, right, that people do come across. So, Marc, I'm going to read the two truths and a lie to you, and then you can expand for our audience about what that really means, right? So here they are. The first one, I can't depend solely on Social Security benefits to pay for my living expenses when retired. That's number one. Number two, it's never too early to start saving for retirement. And number three, I don't need help with my plan. I can use an app for free and get the same information. What are the two truths and which one's a lie, Marc?
Well, I'm just going to say the last one is the one everybody needs to focus on for a minute, because there is a lot of information and things about AI in the news right now, and it's all over social media. We're concerned about it in the financial services business, but I will just say this. Emotions get involved when we start talking Social Security and a paycheck for life, right? And when that happens, a robot is not going to be able to help you. They might give you the different options, but how does that robot know exactly what your situation is? And more importantly, how are they going to deal with that, right? How are you going to deal with it? And one thing that Casey and I truly believe, your situation is very unique to you and no one else. And so you want to be dealing with somebody that can really help on the emotional side of things, right? Because there is a lot of emotion that gets involved when maybe you're worried about, how is my spouse going to be protected if I pass away early? You know, should I start my Social Security at age 62? That's a big question. There's a lot of information that says you should, and there's a lot that says you shouldn't, right? So that, again, causes confusion. So again, I think it's tremendously important to work with a specialist, because that lie that comes out that you can just Google this or get a robo-advisors are going to be able to solve all the key questions for you, I think is a big mistake when it comes to this type of plan.
I totally agree, and I think that this is something, again, that we're seeing more and more often. And at the end of the day, we use AI in some things that we do, right, to help look at analytical things for us. But the key is this: we still have to distill that information to make sure that it's applicable in the circumstance, right? So I think probably the easiest way to correlate it is to think of it almost like a calculator. A calculator will give you the answer, but how that answer applies in your life or in the circumstance, that's up to you to decide. And that's really where the advice of somebody who is a financial planner, who understands all those pitfalls and concerns that come up when you're moving towards retirement, is so important to make sure that you don't have blind spots that your calculator missed, right?
Yeah.
Because at the end of the day, AI, wonderful tool. It does have some great benefits. At this point, right, it's really taken over. Instead of Google searches, everybody uses AI to get answers, right? And there is some level of expansion on those answers that Google doesn't provide. But that doesn't mean that it can apply the information in your individual circumstance. We've used this scenario before, or maybe this illustration, I should say, where when you're looking at retirement and you make a decision about, let's say, Social Security, it's like dropping a rock in a pond. It has a ripple effect, and it hits every other decision that you have to make as you go down the path of creating a retirement plan. And so if you're making each one of those decisions in a silo, in just an individual circumstance, and not considering how they all work together, that can really spell disaster for your retirement plan.
Yeah, because I want to stress, claiming age is something we need to talk about right now, because a lot of people believe that you should go at 62.
Oh, is that not right? You shouldn't just all start at 62? I thought that was the way to go.
I know personally, I didn't start mine until I was 68, and there was some other reasons for doing that. But I just want to stress to our viewers today that your situation is very unique to you, and a lot of people are worried that they should take Social Security at 62 for the reason they don't want to touch their 401k money. And what I would like to say about this is taking your 401k money now could be a really good decision, right? Because the wonderful part about Social Security is it's got that built-in COLA every year and that increase, right? So if we wait, let's say from 62 to possibly 66, we're going to get a big increase. We could get 25% more on our money over a lifetime, not just a few years, but a lifetime. And so when you claim is dramatically important, right? And we tend to believe that possibly using the 401k money first could be a ginormous victory because we don't know what the market is going to do in the future, right? We've been on quite a bull run for a long period of time now, but is that guaranteed to continue? See, we know it isn't. It could, but maybe not, right? And so if my Social Security is going to increase, why not think about using some of the 401k money now and let the Social Security build up? Because if you do that, you may end up paying taxes at the lowest rate you're ever going to see in your lifetime on the 401k distributions. So this is why planning can be really critical, but a lot of individuals don't know what to do, and so they make an emotional decision, and it doesn't mean that it's necessarily going to be the best one.
Right, or you know what, a lot of times we see people get misinformation from a friend or a coworker or something, right?
Yeah.
And undoubtedly that friend or that coworker really does mean well, and perhaps the information that they give is the right thing in their individual circumstance, but that doesn't mean it's the right thing in your circumstance and your retirement plan, because the planning is unique to you and the plan should be designed that way. Now we have one more two truths and a lie that I think we want to make sure we cover, because there's a lot of misconception here about Medicare. So let's look at this. Here they are. The first one, Medicare is free and I don't need to pay anything for health related once I enroll. Number two, Medicare does not cover all medical expenses. And number three, you will spend more when you retire because of higher medical costs. Which one's the lie, Mark?
I'm just going to say this. Medicare is great. I went on Medicare 3 years ago, and I'm so thankful to have Medicare as a benefit right now. It takes care of hospital expenses and doctor expenses most of the time. But you are going to have expenses that come up, even though you have a great Medicare A and B, and then D, if you've got that too. You have to have that from a prescription standpoint, but that doesn't guarantee that you're never going to have any out-of-pocket expenses. In fact, Fidelity just did an unbelievably powerful study that says the average person, when they retire, even that they got Medicare A and B, and possibly C if you went Med Advantage route, is still going to spend right around $173,000 over their normal life expectancy. So you could have some pretty big expenses, and that doesn't even address long-term care, which is not going to be covered by Medicare. So we have to be careful in what we do there as well.
Right, so there's a lot of things to consider. And when you're building a retirement plan, all of these parts and pieces have to play together. And so this is your opportunity. Again, we've opened up 10 spots for our viewers this coming week. If you'd like to come in and get a written financial plan, we will sit down and talk about your Social Security and when the right time is for you to start taking it. We'll talk about Medicare and see if Med Advantage or Med Supplemental is the right decision for you. We'll also talk about taxes to make sure we're being tax efficient. And when you come into our office to have that conversation, we'll give you a copy of our new book, Break the Glass, which we're really excited about. Covers all the parts and pieces that we talk about here on our show to make sure that you can have a successful retirement. So give us a call, 844-342-7142. You see the phone number there on the screen. There's a QR code you can scan as well. Again, 844-342-7142. We're going to take a quick break, and when we come back, we're going to give some scenarios to figure out how we might be able to make the best decisions as we move towards retirement. Don't change the channel. Come right back to Elevate Your Wealth.
Call 844-342-7142 now to receive your complimentary tax map with your written financial plan. Learn multiple strategies that can protect you from higher taxes now and in the future. Taxes are a threat to your financial stability in retirement. Protect yourself from the potential threat of rising taxes. As a retirement planning financial advisory firm, Casey, Marc, and the team will help you navigate the financial waters to pursue your retirement goals. Call 844-342-7142 today. Casey, Marc, and the team offer inclusive retirement services, such as investment directives for your portfolio, income producing strategies, and wealth preservation plans for your family and legacy. Call Mark Casey and the team at 844-342-7142 right now for your complimentary tax map with your written financial plan. Discover tax strategies to keep more of what you have saved in retirement, or use the QR code below to schedule today.
You've got quite an extensive resume. Wow, so many years of management. Bet that was fun. So this job requires basic knowledge of the social media and video platforms, content creation, and SEO. How proficient are you in those areas?
Going back to work after retiring is not ideal. Plan your retirement right. Call now for your own complimentary portfolio review and tax analysis. Hello and welcome back to Elevate Your Wealth. We're really excited to have you here with us today. So far we've talked about Social Security, we've played a game called Two Truths and a Lie, and now we're going to finish with some scenarios, almost kind of like client questions. This might not be an exact scenario that you're dealing with, but it could be similar, and that's why we like to do this, because ultimately we believe that financial planning should be unique and individualized to you as a person. And so these scenarios are representative of a lot of the folks that we've worked with, but everybody's situation is unique. I'm here with Marc Stimpson, as always, and we're talking through these different topics. So Mark, I'll give you the first scenario, and let's see what you come up with, okay? So here it is. They're about to retire, so we have a couple that's about to retire, with $1.2 million spread across a traditional IRA, a Roth IRA, and a taxable brokerage account. What's the smartest order to withdraw from those accounts to minimize taxes over time? That's a great question.
It is, and this is something we basically have to address with 90% of the people that come into our office, right? This isn't unique necessarily. This is a common scenario we see, but what I will say is it's important to understand a lot of other things about this particular client. I just want to commend them. They've saved a nice chunk of money over a period of time. $1.2 million is nothing to sneeze at, right? But the one thing you and I both know, we can't say that that's necessarily enough, right? Because we need to know exactly what they want to spend each month in retirement. It's really all about a cash flow analysis. So until we get that information, it's hard for me to answer, okay, which is the best way. What I will say is this, that if we're concerned tax rates might go up in the future, then I like using some of the taxable accounts now. I want the Roth money, because of those tax advantages, to build up over time. Usually for most clients, not all, leaving that money to the end makes the most sense, but not always. So again, there's so much information that we need about a specific client's financial situation and where their money's going to come from. Are they going to have a pension, right? We didn't talk much about that today. Most people today, unless they work for the federal government or state government, are not going to have a pension. So because of that, there's been a huge need to help them create what we call a private pension, right? And so knowing all of the information about their financial situation is really crucial to be able to act as a true fiduciary, which we are. We want to put the client's interest first, but we need all the information to be able to maybe help them decide which one of these buckets should I draw from and when. That's critical to our type of planning.
It really is, and I love the way you answered that, because it's exactly right. There is no clear answer on that question. It is situational. Now, there are some guidelines that kind of generally fit, but does that mean that it's the best thing in your individual circumstance at home? And we don't know that until a conversation is had, right? And so we actually won't give those type of answers to those questions, because we can't act as a fiduciary until we know the details to make sure that the information that we give you is accurate. And so that's a really important piece. Now, I do appreciate what you said about the using Roth last, right? Because generally speaking, if we wait longer on our Roth, it's more tax efficient over time. And that also allows us to potentially be more aggressive in the investments over time and allow that money to grow. But you know, it was mentioned in the scenario that this couple has some appreciated stocks potentially, right? So do we deal with those stocks now? Do we take the money out of the traditional IRA? And age has a lot to do with this too, right? If somebody's 73, right? They have to take money out of their traditional IRA whether they want to or not. And so it all comes down to the individual unique circumstance to make sure that we're doing it the right way.
Yeah, in fact, one of the things I think that is a concern right now for a lot of people is, should I convert some of my traditional IRA to Roth IRA, right? We run the scenario. We have some pretty cool software that will help us determine that. One of the things that we've come to realize over the last few years is Roth conversion, not Roth contribution, but Roth conversion isn't necessarily always a great scenario for clients, even though everybody on the internet's talking about let's go out and do Roth conversions, right? And all I want to say to our viewers is that may not be the best advice. It can be in a lot of situations, but again, we don't know until you come in and talk with us and share your specific situation, because Roth money in the end is really, really good to have, right? Because Uncle Sam's kind of out of the picture. Right? And we don't, if we die and we have Roth money, that money does transfer to our children, right? With no taxable consequences to them. So again, Roth money can be really, really wonderful, but it doesn't mean that you should convert all of your IRA money to Roth IRA. That could be a bad mistake, especially if we don't have enough time for that conversion to really pay off.
Right. It still needs to be strategic, right? There still has to be a plan. And sometimes we see that people come in and they just want to go straight to a Roth conversion for everything, and that can really spell disaster. So let me give you one more scenario. We have just a little bit of time to cover it, but let's take a look. Here it says they're budgeting $500 a month for health care in retirement, but have heard Medicare doesn't cover everything. How can they plan for big medical expenses without draining their investments?
What I want to say to this case, $500 a month, that sounds good, which would be $6,000 a year, right? And I want every client to have saved at least that much, but if something major happens, especially in the long-term care field, that isn't even going to be close to enough, right? And I think that is one area that people don't give enough consideration to, is long-term care planning. Because if there's going to be something going to blow up a great plan that we set up, it's going to be that. Because in our area right now, you could be looking 15, 16, possibly 17,000 or more per month that's not touched by Medicare. So you are going to have expenses way above that, and it could end up bankrupting you if you tend to not want to deal with it or talk about it, because this is the biggest area of concern that we have that could ruin a great plan that we've set up for our clients.
It really can. Yeah, that can decimate a retirement plan, right? And there's some misconceptions there. And ultimately, you've got three choices, right? You can self-insure. You can do some sort of long-term care planning, buying some kind of insurance for that, or the state has a plan for you, which I promise ultimately you're not going to like, right? So that's what it really boils down to. Now, Mark, we have 10 spots open. The viewers at home have the phone number on the screen. Would you tell them what they can expect if they give us a call?
Yeah, I'd love to do that. So if you're listening or watching the show today, please pick up the phone and give us a call at 844-342-7142. And I promise you, all we're going to do is have a conversation. We're going to talk about Social Security. We'll talk about Medicare. We're going to talk about taxes. What's the best way to deal with that? What about, how should I move money to my next generation, my children or grandchildren? So please, pick up the phone, give us a call. You'll see the number right there, 844-342-7142. And if you come into our office, we're going to give you a copy of our book, Break the Glass. It deals with everything we've talked about today, so give us a call.
Thank you so much, Mark. It's been great having you all here. We'll see you again next week right here on Elevate Your Wealth.